Hi guys, welcome back to another podcast from lessonsfrombooks.blog. Okay, so this week, number 4 is Rich Dad, Poor Dad, what the rich teach their kids about money that the poor and the middle class do not. Okay, so Rich Dad, Poor Dad was another one of those books that reframes everything when you look at wealth creation. After you understand this, you'll see, if you already don't, you'll see investing time and money very, very differently. Okay, so you'll notice nearly everyone has it wrong. Also, that the people that are continuing to amass great wealth apply this simple method in everything they do. Again, simple method doesn't mean easy. Before jumping into the lessons, I want you to define a few things for yourself. You need to define your hourly rate. So I'll do this with you so we can carry on. You're going to need this later when defining assets. Trust me. To do this, take your annual current income before tax and divide it by 1600. So this is on the basis that you work 200 days per year at 8 hours a day. Thus your hourly rate is worth X. If you work less hours per day on average and less days per year, then obviously the amount you divide it by is probably going to be a lot less. Thus your hourly rate is going to be a lot higher, and obviously it should be. Ideally, you don't work 8 hours a day for 200 days a year. You work very little. But I'm assuming that's the bracket you're in. Obviously apply this to your life. So define your hourly rate. So that's the total hours that you work every year. You take the total current income, you divide it by those total hours. Secondly, you need to open your mind to the possibility that what you've been taught about building wealth is completely and utterly wrong. Poor Dad, Rich Dad is probably one of the best books, similar to The Richest Man in Babylon, which I'll cover in a later podcast and blog. It reframes everything. And just so much of what we're taught shows you that it's the system programming us. So let's get into the lessons. So number 1, you must think as a producer rather than a consumer, an owner rather than a customer. We're programmed from birth, guys, to think as consumers, customers, rather than producers and owners. This is the biggest blocker in building wealth. Okay, number 2, to get rich, you must purchase assets, not liabilities. Nearly all assets are actually liabilities. So it's this simple, okay? An asset puts money in your pocket, and a liability takes money out of your pocket. An asset puts money in your pocket, and a liability takes money out of your pocket. Okay, some examples of assets that are actually liabilities. This one's a bit controversial. Most people don't understand when they first hear it, and it makes them think that so many things they've been told is bullshit, and it's because it is. The first one is the house that you live in that you have a mortgage on. That is not an asset, that is a liability. Why is it a liability? Because every month a mortgage repayment comes out. You have to put all of your capital into it to get the mortgage. Then every month a mortgage repayment comes out. And then you've got a bunch of other costs to keep the house up and running. That's a liability. Okay, I will cover different examples of houses in the next section, so don't worry. Some houses can be assets, but if you live in it and you've got a mortgage on it, it's a liability. Sorry. Okay, the second one. Any object that doesn't appreciate in value. So that's cars, boats, electrical products, clothes, shoes, watches, jewelry, etc., etc., etc. Okay, another example of an asset that's actually a liability. Starting a business or owning a business that takes all your time to run. That's not an asset, that's a liability. Okay? An example of a true asset is the following. A house that you own or have a mortgage on that provides you a rental income every year, said year, not month, that's greater than all the costs per year, and this includes your annual time cost. Again, use your hourly rate to calculate this that we defined earlier. How many hours a year do you have to spend on that house when you rent it out? If you add that in to your calculations, you'll find that renting out houses in many cases actually is a loss leader, but there is many ways to make that work. I won't go into that now, but that is an example that can be a true asset if it's managed efficiently. Another example of a true asset is a business that you own, that's public or private, or that you have shares in, sorry. So that's a form of ownership, not necessarily 100%. That provides you with an annual dividend. Key thing, provides you with a dividend. So that's putting money in your pocket, as we defined earlier. And over a 10-year period, it appreciates higher than the stock market. If it's not appreciating over a 10-year period, as in the value of the company, better than the stock market, then you're better to put that capital into the stock market rather than in that company or companies. Okay, you have to analyze each company that way. Probably the best example of a true asset is shares in a low-cost stock market index like the S&P 500. I keep going on about it. I'll cover it in many podcasts, but it's the best asset to own. Point blank. Go up on Google and go look at what Warren Buffett says he's deploying his capital into. What's left when he dies, what you'll find is it's 90% going into the S&P 500. Okay, number 3. You are defined as wealthy when you never have to work again because your annual income covers all your possible annual costs forever. Okay, so don't get that confused. Each word in that lesson is important. Let's break it down. Wealthy is defined as you never have to work again. You can, but you never have to. Your annual income must come from assets, not your time, aka work. Okay, the next part. Covers all your possible annual costs. So annual costs are accommodation, food, general living costs, healthcare, the gym, presents for friends and family, throwaway money, cars, jewelry, clothes, etc. Helping family and friends when they need it, charity, literally any cost, any possible annual cost. And then the last part, which is key, forever. So this may seem obvious, but most people think short term. This is why a lot of people don't build wealth. They get rich and they lose it. So again, going back to the point, you're defined as wealthy when you never have to work again because your annual income covers all possible annual costs forever. Okay, so imagine owning an asset that provides you an income for 100 years. That's how you must think about building wealth in your family to last. It's exactly what the most wealthy do every day. Study them and you'll see the same behavior. That's why I mentioned the low cost stock market index, S&P 500. If you would have put, I can't remember the exact numbers, but if you would have put £1,000, $1,000, whatever, in 1900, by 2000, you would have 1 million. So that's in 100 years, it's times to 1,000. Now imagine each 100 years that's timesing by 1,000. Now if you extrapolate out 500 years, that turns into a lot of money very quickly. Now people don't think in these terms, but this is probably the most reliable way to build great wealth that keeps your family supported forever, literally forever. This is why the rich get richer. It's very simple. It's just a compounding machine. It's all it is. So if you imagine it times by 1,000 every year, and year one you put the money in, you put in $1,000. Now, obviously, I expect you'd want to put in a lot more than that, but let's just still stick with round numbers. And the stock market goes up by somewhere between 4 and 5% every year, and there's a dividend yield as well to take into account. So if we say 1,000 times, say it's around 4.4% per annum. and we compound that over 100 years. And we continue to do that we do that again. Another 100 years. Again, that turns into not a number. So you're talking hundreds of billions over years with a very small amount at the beginning. So yeah, sorry about the digression, guys, but just to explain the power of compounding. You need to focus on something that's going to build to last. Okay, so number 4, the cash flow quadrant. Now, you won't be able to see this if you're listening to this in audio version, but the cash flow quadrant is broken up into 4 quarters. On the top left, employee, so that means you have a job. So that's most people, no leverage, don't really have any wealth. On the bottom left, S, which is self-employed, which means you own a job. Again, no leverage. That's about 95% of the population. Okay, business owner is the top right, so you own a system, so that's leverage. So that's about 95% of the wealthy people in the world. Yeah, their income is not bound to the work they do. And then the bottom right, which is the one you want to, you want to aim for. You don't want people working with you to generate money. You want money working for you to generate money, because money is much more powerful than any person is. So the bottom one is investor. You own investments. So this is 5% of the population. This is what you should be aiming to. Okay, so that's all the lessons for this week, guys. Again, this is Rich Dad, Poor Dad. This is the lessons learned from Rich Dad, Poor Dad. Yeah, thanks a lot, guys. Thanks for listening. Next week, we'll have another post. I'll be publishing that next week, and these will come every week, guys. So be sure to subscribe to YouTube and the podcast as well. Yeah, thanks for listening.